Hello everyone, and welcome back to the channel. Today, we're diving deep into a topic that separates consistently profitable traders from those who are just gambling in the markets. It's not about finding some secret indicator or a magic formula. It's about something far more powerful, adopting a disciplined approach with a set trading plan. You've probably heard this a million times, but are you actually doing it? Let's be honest. Many of us get into trading with visions of quick profits, but we soon find ourselves making emotional decisions, chasing hot stocks, or panicking when a trade goes against us. Does that sound familiar? If so, you're not alone. The good news is, there's a solution, and it's the bedrock of all successful trading careers. So, what exactly is a trading plan? Think of it as your business plan for the market. It's a comprehensive document that you create for yourself, outlining every single aspect of your trading activity. It's your rule book, your guide, and your shield against emotional decision-making. It tells you what to do, when to do it, and why you're doing it. Trading without a plan is like trying to navigate a vast ocean without a map or a compass. You might get lucky for a bit, but eventually, you're going to get lost. Let's break down the essential components of a robust trading plan. First and foremost, you need to define your why. What are your goals? Are you looking for long-term wealth accumulation, supplemental income, or are you aiming to become a full-time trader? Your goals will shape every other part of your plan. Be specific. Instead of just saying I want to make money, try something like, I aim for a 15% annual return on my trading capital while risking no more than 1% per trade. This gives you a clear, measurable target. Next up is your trading style. Are you a day trader, getting in and out of positions within the same day? Are you a swing trader, holding positions for a few days or weeks? Or are you a position trader, with a much longer time horizon? There's no right or wrong answer here. But your chosen style must align with your personality, your risk tolerance, and the amount of time you can dedicate to the markets. Someone with a full-time job probably can't be a successful scalper who needs to watch the charts every second. Be realistic about what works for you. Once you've settled on a style, you need to define your trading strategy. This is the real meat of your plan. What specific setups are you looking for? What criteria must be met before you even consider entering a trade? This could be based on technical indicators like moving averages and RSI, chart patterns like head and shoulders or triangles, or fundamental analysis. For example, your rule might be, I will only go long on a stock if it's above its 50-day moving average, the RSI is not in overbought territory, and it has just broken out of a consolidation pattern on high volume. Whatever your criteria are, write them down. Make them crystal clear and non-negotiable. This is your edge. Now, let's talk about the most crucial part, risk management. This is what will keep you in the game long enough to be profitable. Your plan must have strict rules for this. The first rule is position sizing. How much of your capital will you allocate to a single trade? A common rule of thumb is to risk no more than 1% to 2% of your entire trading account on any single trade. This means if you have a $10,000 account, you should not lose more than $100 to $200 if a trade goes against you. This leads directly to your entry and exit rules. For every trade you plan to take, you must know your entry point, your stop-loss level, and your profit target asterisk. Before asterisk, you click the buy button. Your stop-loss is your emergency exit. It's the price at which you admit you are wrong and get out to protect your capital. It should be based on your technical analysis, not on how much you're willing to lose emotionally. Your profit target is where you plan to take your gains. This could be a specific price level, a certain risk-to-reward ratio like 2-to-1 or 3-to-1, or a trailing stop that lets your profits run. Having these three levels defined removes all the guesswork and emotion in the heat of the moment. The market is fluctuating. Your P&L is flashing green and red ... but it doesn't matter. You have a plan. The price hits your stop loss, you exit. No hesitation. No hoping it will turn around. The price hits your profit target, you exit and take the profit. No getting greedy and hoping for more. You simply execute the plan. This is where discipline comes in. Having a fantastic plan is useless if you don't follow it. Discipline is the bridge between your plan and your results. It's the mental fortitude to stick to your rules, day in and day out, even when it's difficult, even when you miss a huge move because it didn't meet your setup criteria, even when you take a series of small, disciplined losses. Discipline means accepting that you won't catch every move, and that's okay. You're not trying to be a hero, you're trying to run a profitable business. So, how do you build this discipline? It starts with practice and accountability. Keep a trading journal. For every single trade, log the date, the asset, your reason for entry, your entry price, your stop loss, your profit target, and the outcome. At the end of the week, review your journal. Did you follow your plan on every trade? If not, why were you feeling greedy, fearful, impatient? This self-reflection is invaluable. It helps you identify your psychological weaknesses and work on them. You are your own boss, and you need to hold yourself accountable. Another key part of maintaining discipline is managing your mindset. Understand that losses are a part of trading. They are not failures, they are business expenses. The best traders in the world have losing trades. The difference is, they keep their losses small and manageable, and they don't let them affect their decisions on the next trade. If you take a loss that was within your plan, that's a good trade. If you take a win that came from breaking your rules, that's a bad trade, because it reinforces bad habits that will eventually lead to disaster. Let's recap the process of building your disciplined approach. 1. Define your goals and trading style. 2. Develop a specific, testable strategy with clear entry criteria. 3. Create ironclad risk management rules, including position sizing, stop losses, and profit targets. 4. Write all of this down into a formal trading plan. 5. Keep a detailed trading journal to track your performance and maintain accountability. 6. Follow your plan with unwavering discipline, understanding that consistency is more important than any single trade's outcome. Creating and following a trading plan is a journey, not a destination. Your plan will evolve as you gain more experience and as market conditions change. You should review and refine your plan regularly, perhaps every month or quarter. But the core principle remains the same: plan your trade and trade your plan. This disciplined approach transforms trading from a stressful, emotional roller coaster into a calm, methodical process. It frees you from the anxiety of uncertainty because you always know what you're supposed to do. Your job is not to predict the future. Your job is to execute your plan flawlessly. Do that, and you'll put yourself in the best possible position to achieve long-term success in the markets. Thank you so much for watching. I hope this breakdown helps you build the structure you need for your trading journey. If you found this video valuable, please give it a thumbs up, and don't forget to subscribe and hit that notification bell so you don't miss our future content. Leave a comment below and let me know the number 1 rule in your trading plan. Stay disciplined and trade safe. See you in the next video.